Welcome to Capital Gains. In this insightful video, we'll unravel the genius of Warren Buffett, exploring the critical signals he watches for in the dynamic world of stock investments. From scrutinizing management quality to deciphering market sentiment and understanding economic indicators, join us on a journey through Buffett's time-tested strategies. Gain the knowledge to identify potential pitfalls and make informed decisions in your investment endeavors. This is your guide to honing a keen eye for red flags and acquiring the acumen needed to navigate the complexities of the stock market successfully. By the end of our journey, you'll have a better grasp of how to navigate the stock market wisely. Let's talk about the price to earnings (PE) ratio. When Buffett checks a stock's PE ratio, he's essentially figuring out if the price you pay for a share makes sense given the company's earnings. A super high PE ratio can be a concern, suggesting investors are shelling out more for the stock than the earnings justify. This might signal overvaluation and higher risk, possibly leading to disappointing returns. On the flip side, a lower PE ratio could mean the stock is undervalued, offering good value in relation to its earnings. It's not a green light to buy all low PE stocks, but it's a crucial factor for Buffett when assessing a stock's value. Now let's chat about earnings growth consistency. Buffett loves companies with steady earnings growth, and it's not just about stability, it's about predictability. Businesses with all over the place earnings are riskier investments. Think of it like a roller coaster, fun at an amusement park, but not for your investments. Steady, consistent earnings growth shows a company's ability to navigate economic ups and downs while staying profitable. This consistency reflects a well-managed business that can handle market challenges. Finding a company with a track record of smooth earnings growth is like having a reliable compass for your investment journey. It gives you direction and confidence in consistent returns. Now, let's touch on debt levels. Warren Buffett isn't a fan of companies drowning in excessive debt, and it's for a darn good reason. Too much debt can be a recipe for disaster, especially when the economy hits a rough patch. A company loaded with debt might struggle to meet its financial obligations, including interest payments. This can set off a chain reaction, potentially leading to the company defaulting on its debt or facing serious financial stress. To check out a company's debt levels, Buffett looks at the debt-to-equity ratio. This ratio gives you the lowdown on how much debt a company has compared to its equity or net worth. A high debt-to-equity ratio is a warning sign that the company might be heavily leveraged and more susceptible to economic challenges. On the flip side, a lower debt-to-equity ratio signals a healthier financial position and a lower risk of financial distress. Keeping tabs on a company's debt levels is like ensuring your investment is on solid ground, ready to weather economic storms. Buffett often talks about a company's economic moat, likening it to a protective barrier that shields it from competitive threats. Just like a medieval castle's moat deters invaders, a company's economic moat discourages competitors. When Buffett checks out a stock, he looks for businesses with wide and enduring economic moats. This moat could come in different forms, maybe a unique product or service that sets the company apart, creating a quasi-monopoly. Or perhaps it's a powerful brand name that consumers trust, making it tough for new players to break in. Buffett's fascination with economic moats goes beyond defense. He knows that a robust moat can lead to sustained profitability and pricing power, letting a company thrive even when times get tough. So, when you're sizing up a stock, think about the strength of its moat. It's like inspecting the fortifications of a castle before deciding to invest. In the realm of investing, having capable and honest management is like hitting the jackpot. Warren Buffett knows that evaluating a company's potential involves looking for not just competent, but trustworthy leadership. Effective leaders can navigate challenges, adapt to market changes, and make strategic decisions that benefit shareholders. On the flip side, poor management decisions can lead to financial trouble, operational inefficiencies, and even corporate scandals that erode shareholder value. Buffett has a knack for making investments when others are gripped by by fear or uncertainty. His advice is to be cautious when others are greedy and to be greedy when others are fearful. This reflects his contrarian approach to investing. When the market is euphoric, he exercises caution, waiting for more favorable conditions. By focusing on the intrinsic value of a stock rather than getting swept up in market sentiment, you can avoid overpaying for investments, providing a margin of safety during turbulent market periods. Dividend-paying stocks hold a special place in Buffett's heart. He believes in the power of dividends to reward shareholders and provide a steady stream of income. When assessing a stock, he looks for a consistent and growing dividend history. Dividend payments reflect a company's ability to generate cash flow and return it to shareholders, demonstrating financial strength and a commitment to shareholders. Dividend stocks can offer both income and potential capital appreciation, providing stability even in volatile markets. Buffett's investment philosophy also includes considering a company's competitive position within its industry. He seeks businesses with enduring competitive advantages, often referred to as economic moats. These advantages enable a company to maintain or expand its market share despite competition. When analyzing a stock, Buffett looks for signs that a company's moat is not only present but also widening over time. This could involve proprietary technology, strong brand recognition, cost advantages, or network effects that make it increasingly difficult for rivals to challenge the company's dominance. Buffett's investment approach isn't limited to analyzing individual stocks. He pays close attention to broader economic indicators, understanding that macroeconomic conditions can significantly impact stock performance. Key economic metrics like unemployment rates, inflation, and GDP growth rates offer insights into the overall health of the economy and can influence specific industries and stocks. Low unemployment rates may indicate a strong economy with potential for robust consumer spending, while high inflation rates can impact corporate profits. GDP growth rates provide a snapshot of a country's economic health, influencing the business environment. One of Warren Buffett's timeless principles is the concept of a margin of safety. This principle recommends buying stocks at prices significantly below their intrinsic value. Essentially, it's a strategy to safeguard yourself from unforeseen events, market downturns, or miscalculations that can impact stock prices. Think of it like buying a car at a price well below the market average. In such a scenario, you'd have a cushion of savings or a margin of safety in case unexpected repairs are needed. Similarly, when you invest in a stock with a healthy margin of safety, you're providing yourself room for error. Even if your initial assessment of the stock's intrinsic value is slightly off, you're less likely to incur significant losses. In summary, as you venture into the world of investing, remember that Warren Buffett's wisdom goes beyond avoiding bad investments. It's also about identifying opportunities with the potential for significant growth. By paying attention to the red flags he watches for in expensive stocks, you can make more informed decisions and navigate the market with confidence. As we conclude our exploration into identifying stock investment red flags with Warren Buffett's insights, I hope you've gained valuable knowledge to enhance your investment journey. If you found this video informative, don't forget to give it a thumbs up. Share your thoughts and questions in the comments below. For more insightful content and to stay updated on the world of investments, subscribe to our channel. Your support keeps us motivated to bring you quality content. Thank you for joining us, and we look forward to having you back for more enriching discussions. See you next time.